Let's now bring in former Atlanta Fed President Dennis Lockhart. Dennis, great to have you with us.
Thanks, Melissa.
What do you make of the Fed staff's prediction of a mild recession later this year and the Fed's decision to go ahead and raise rates? I mean, do you think that it's a tacit or implicit acceptance that we will have a recession later this year?
Well, first, let me explain. From my memory, the staff is somewhat independent of the governors and the presidents in putting forth what they think is going to happen, premised on appropriate policy. So it's not a Fed position per se. I think the voting members of the committee are perhaps a lot more important, and they each have staffs behind them, at least the Fed presidents do, who do modeling and have come to their own conclusions. So I think it's one input about what the atmosphere in the Fed is as regards a recession later this year. Having said that, I noted it when I read the minutes a few minutes ago, that the staff is really predicting a recession later this year. I think it's important. I think it also feeds the overall sentiment that I read, and that is they feel they have more work to do, and therefore come May 3rd, they're probably going to increase by another 25 basis points.
What's your view, Dennis, of the impact of what's gone on in the banking crisis and the expected tightening of credit to come, and how that factors into the Fed's decision? I mean, we've heard from many Fed officials saying that they believe that the banking turmoil is contained. We've heard it from a lot of people, but I'm wondering what your take on it is. As we watch the stocks continue to have a rough ride, I mean, there's no indication in how the stocks trade, at least, that things are over.
You know, I think you have to be cautious on this question. I don't think we're out of the woods, that the whole environment has settled back to something we'd call normal. So, I think you have to continue to monitor the situation, and who knows, something more could happen in terms of a bank failure or whatever. So, first, I think that's the first point. It's uncertain that we're completely out of the woods. And then second point, I think, is that the committee seems to be paying very, very close attention to the credit contraction risk in the economy, but it's a little early to really assess it, and they said as much in the minutes.
Dennis, how come we don't hear about QT being tightening? How come we don't hear about the financial crisis being tightening? Isn't that enough? Why does the Fed have to do anything right now?
Well, first of all, I think the tightening effect of QT on the real economy is more of an unknown than a known. It's something that there have been a lot of staff papers written about, and a lot of very serious economic studies to try to quantify it, but it really isn't known, and it's a variable that the committee wants to put on the back burner and just proceed with. So I think the fact that we don't hear anything about QT is because it really is a background matter from the point of view of policy.
Dennis, this is going to be a bit of a wonky question. I hope, though, it doesn't come off that way. The Fed should have a balance sheet, and some of its money supply, it all plays in, right? So I think you and I both would agree $9 trillion is the wrong number, but it should be, probably greater than 6. Where should it be given this environment and given money on all those different things? Because we're probably, in my opinion, 30% or so in excess.
Your estimate is pretty good, I think. We're in a new era of ample reserves, not scarce reserves. Prior to the 2008 financial crisis, we had basically a situation of very scarce reserves. When I joined the Fed in 2007, the balance sheet was $800 billion. Today it's almost $9 trillion. $6 trillion is as a stopping point, and then letting natural growth occur is a reasonable estimate, it seems to me. They will feel their way along until they feel the market is telling them that the appetite for reserves is at its bottom, and then they'll stop. But but I think 6 trillion is a reasonable estimate. Could be lower.
Dennis, it's always great to speak with you. Thank you.
Thank you so much, Melissa.
Dennis Lockhart. I talked to Mark Zandi of Moody's a couple weeks ago, and he said that he believed that the coming credit tightening as a result of what's gone on in the banking sector is the equivalent of 2 to 3 rate hikes of 25 basis points. That has not been factored in yet.
So they're done? Is that what you're saying? They could be done?
Or they're going to keep going on ahead, and then this is on top of it, and they're over tightening.
Right. Well, he's right. I mean, if he's right, then they do have a little draft kind of cover to hide behind to wait and see for a couple months and see if that actually does happen.
It's interesting. You know, we're small business, right? We talk about, there was a confidence reading this week, and I think Jeff Gundlach tweeted it out from DoubleLine that literally the index is plummeting, right? So you're seeing, at least in the expectations of small businesses, and let's not, small is the small word. Small businesses employ maybe 2/3 of the people in America, right? So if their confidence in the economy, if their confidence in their ability to access credit, their confidence in the banking system is shaken, that is the sort of thing that's going to work its way through our economy at the wrong time. So we talk about, whether they're going to continue to push and continue to raise and QT to Steve's point and all this sort of stuff. I mean, listen, it's likely the economy is going to shift below their feet before the Fed has pivoted or paused or anything like that. And at that point, they're going to be behind the 8 ball again. So as far as an investor is concerned, I think, taking some stock of valuations, taking some stock of this, highly anticipated recession, whether it's a shallow one, whether it's long, whether it's deep, whatever. I mean, I just don't know. I just don't think the valuations make a whole heck of a lot of sense here. And I'm not just trying to sound like an absolute perma bear. Over the last year, there have been times where I've been very constructive on the opportunity to buy stocks. I just don't think, given the uncertainty that we have right now and where rates are, this is one of those good times.
Well,
especially.
Plus the market's 20% higher than that time in October.
And just quickly, you sold Microsoft.
I did.
What?
She browbeat me last night with all these good reasons to sell it, and it was indefensible that I still owned it, but I do own half still.
Right, but the valuation.
The valuation at 30 plus times.
Concerning to you.
Yeah, very.